बीएमसी वाली डस्टबिन नहीं आती है।
State Bank of India is working on a bailout package for Yes Bank. The country's largest lender said it's studying the RBI's draft plan and will indeed lead the rescue plan. What's not decided is if it's going to be the sole investor, and actually even how much will it eventually hold, and thereby how much will it potentially invest. Yes Bank's the first private lender, a sector lender, of that size and that importance to be put under moratorium, and questions are now being raised on whether the contagion could spread. Amit Mantri is one such expert who believes that this could well be a start of such an issue. Unless I'm very wrong, that's what he wants to convey as well, and he joins us to tell us why. Also joining us on the conversation in some time will be Dhananjay, Sinha, the head of institutional research at Systematics Group, who I think believes that this move taken is actually probably the best outcome that would have been possible. Now, Amit, thanks for joining in. Your tweet created a bit of a stir as well. I just wanted to ask you that if indeed you believe that this action that has been taken is not a good one, what else could have been done?
So, in my view, this action pretty much destroys the franchisee value of Yes Bank. So whatever decision should have been taken, that should have not involved a moratorium. So ideally, much before, maybe a few months back in the Q3 or Q2 quarter itself, the RBI and some of the leading banks should have ensured that there is a large infusion of capital that happens. State Bank of India, LIC, HDFC, Kotak, the best of the financial institutions, they should have come in together and maybe invested maybe $1 billion or a couple of $1 billion. With the moratorium, what happens is you end up killing your liability franchisee. Depositors who account for almost 2 lakh crores of deposits with the banks are now in a state of shock and panic. They were already withdrawing capital. We could see that in Q2 numbers as well. It's believed that even in Q3 that was happening. But now with this moratorium in place, we are probably going to see a rush to exit from the bank as soon as the moratorium is removed. And if that happens, there is very little value that remains in Yes Bank because the liability franchise is a big part of the value of a bank. And the moratorium also kills many of the partnerships that Yes Bank had. For example, Yes Bank was very strong in the fintech ecosystem. The likes of PhonePe and all were using it exclusively for its UPI services. And now with their services getting disrupted, they have now pivoted off to other partners. And once the moratorium gets lifted, they're again not going to come back to Yes Bank. So because this current proposal kills the franchisee value, I think it's not ideal. Any solution that should have been proposed should have ensured that there is no moratorium and should have been solved much before.
Well, so Dhananjay Sinha also joins in this conversation. Dhananjay, that point is well taken that maybe this could have been or should have been tackled way before. My question though is that with the presumption that this is, or Friday was the day or Thursday was the day when a decision would have been taken, and let's assume that was the first day, could there have been an option other than the moratorium being put in as well? Because I think a couple of arguments that have been made is that no one quite had a correct estimate of how deep did the rot go down to, and therefore if a moratorium would not have been announced, it would have been meant a run on the money immediately that day itself, and Yes Bank would not have the financial wherewithal to be able to deal with that. Other institutions coming in might not have wanted to be a part of such a deal as well. What is your reading about this? Are you bullish? Are you okay with this solution, or would you believe that there could have been something done better?
So I think it's a valid question. Why did you have a sort of a moratorium announced a couple of days before you came up with a sort of a plan? So I think there must have been a very strong compulsion for the RBI to actually do that. So the thing is, the problem with the liability franchise of the bank is that it is heavily dependent on wholesale deposits. I think roughly about 40% of the total deposit is wholesale, and possibly the drawdown in deposit that were happening even in the previous quarters may have aggravated, and possibly there would have been there was a sort of a bigger withdrawal that is happening on the wholesale side. So that makes your ALM very asset liability management very risky, and then it has an impact on the asset side as well because of the mismatch. So I think what may have happened is a threat of a much larger withdrawal that would have impacted the asset side and possibly aggravated the asset quality even more. We all know that there is a fairly high sort of level of vulnerable assets in the bank's book, and if you look at the BBB rated book, loan book, and also the book which is beyond which is BB and beyond, that would be roughly in the region of 90,000 crores, and the risk of write-off was very high. So I think what RBI may have done is to actually respond to a sort of impending situation. This is my guess. RBI will know exactly what was happening, but effectively what it means is that the response was fairly delayed, because I think the drawdown in deposits were happening even before, and I think if the regulator was more alert and sort of took expeditious measures, the moratorium on deposit would not have happened. So I think this is an important thing. With respect to the package itself, I would say that there is more to come. I would say the requirement for recapitalization of this bank would be anywhere in the region of 20 to 21,000 crores. What SBI has committed is 2,450 crores. They have sounded very confident that there are multiple other investors who will be participating in the immediate response that the bank requires. But I suppose over the medium term they will require more capital as the bad asset starts to materialize and it starts to erode the capital further. So I think those are the things. So the uncertainty with respect to future capitalization, uncertainty with respect to getting more investors in future fundraising will also linger on. Initially, I would say that the stock price has actually responded positively after a correction of almost like 50-60% last week. So I think it will need to evolve. You know, the investors will need to be shown the confidence that there is expeditious measures as a follow-up to the immediate response very quickly. But I think the other panelists also talked about this, that the switch of deposit base to some other bank, to larger bank, is a real risk that policymakers will have to really look at, not just for Yes Bank but other banks as well.
Actually, some of it is playing out as well. Actually, I've heard a number of cases within Mumbai itself wherein the accounts have been done. Mutual fund houses have come in and said that they are not remitting money to the Yes Bank account of an account holder. If they want to redeem, they are happy to help the account holder start off another bank account and then remit the money only there. So I think that risk is anyways playing out as we speak. Amit, the question is this though. What could have been done is great, and I think both of you confer that most people would probably believe that the run on the money might have been already in play, as a result of which this has come in at this space, maybe coming a bit too late. What can happen now? Now, would you believe that an integral part of the resolution would be a necessity to get in not just SBI, which is a great name in itself, but a couple of other names as well coming in and picking up some small slices in order to show that the system is behind that? And in what shape or form would you reckon would be the immediate need of the hour whenever it happens in the next 5, 10, 15 days?
So yes, SBI is by far the strongest bank. So once SBI is behind, Yes Bank, everyone knows that now there is nothing to worry for depositors. Things will be fine. But really, now you need to get positive headlines for the bank. You need to ensure that the depositors have not even an iota of doubt of any moratorium in the future or any risk to their capital. So which is why it is ideal to get some other large institutions also behind the bank, be it LIC, be it some of the private banks who have very good brand names, the likes of HDFC, Kotak. So when you see, when a depositor sees that, okay, now while earlier, there was issues now and there was a moratorium, but all those issues are now in the past. So therefore, let me not really worry about my deposits, whether they are with Yes Bank or with anyone else, because now the bank is absolutely well capitalized. SBI said that they will be putting in around 2,500 crores initially, but look at all the other banks who are also going to be coming in, all the other institutions who are also coming in. So the fact that now there's going to be enough capital that is going to be available to Yes Bank might put some of the depositors at ease, might put some of even the wholesale depositors at ease. With only Yes Bank coming in, and that too as a kind of a minority investor, wherein it will not be more than 49%, it still appears that it's not everything is behind the bank as such. So I think what the system needs to say right now is that we are going all in ensuring that every liability that Yes Bank has will now be protected. Forget risk of deposit. There is no longer risk of further moratorium as well, even if depositors want to take out a large amount of capital. That itself will ensure that the confidence of people increase. Maybe the stock price does better because of that, and because of that, there's again and now a positive cycle that starts kicking in. It's a lot of it is just really game theory. If I'm a depositor with the bank, even if I'm not worried about the risk to my deposits, but I'm worried that others might be taking out money, that forces me also to take some action.
So Amit, failing that, you reckon that, and a bit of optics as you mentioned, but failing that, you reckon that once the moratorium period is over, people might come in and take the money out, and that might actually create further problems for Yes Bank. We've temporarily stalled it, but the spigots may open again.
No, I think I think we should assume that that's a very high likelihood, and as you mentioned, we have already seen signs of that. Mutual funds, broking houses are all asking their clients to change their payout accounts from Yes Bank to some of the other bank accounts. So that means that if anyone has been investing through their account into stocks or mutual funds, they would have already shifted out to newer bank accounts. And once the moratorium is lifted, it's unlikely that they are again going to shift back to Yes Bank. It's more likely that whatever funds are lying in the Yes Bank account, they are likely to switch it to the newer bank account. So already many of the ecosystem players are ensuring that once the moratorium gets lifted, a large part of capital gets removed. So, I think we should assume that there is going to be withdrawal of deposits, assuming that it will not happen, and that since the moratorium has been announced and now you have SBI as the backer for this bailout, people will now be satisfied. I think that would be too optimistic an assumption.
Yeah, and Dhananjay, that's the other point, right? I mean, so there are 2 points out here. One, whether this action and subsequent actions, what is needed. Amit believes that a couple of other names coming in are needed. And I would argue that not just for the purpose of Yes Bank alone, but so that it doesn't have any other fallouts, which might have been prevented by this. What needs to be done? Also, part 2 of my question, would you believe that this 2,450 crores, which is doing the rounds right now, is too small a number, and SBI or SBI plus would actually need to bring in more capital, even if we don't take into account that there'll be a run on the deposits and just the normal functioning of the bank continues?
Yes, so the thing is, whatever SBI has promised to contribute, and whatever other investors contribute, all of that will still be falling short of the capital requirement over the next 1 year. So I think there will need to be follow-up recapitalization of the bank, and sooner it is done, better it is, because if you have a drain on deposits, then your asset side will also get impacted with a lag, and that will aggravate the asset quality issues as well. So I think front loading the recapitalization in a big way will be a very strong message, both for the depositor and also for the borrowers of the bank. So I think more action will need to be taken. So that's my short answer to your question.
Okay, so let's I mean, this is all points to ponder. We do not quite know what will happen, but let's lay it out so that people at least know action X or action Y, what kind of impact could that have? Amit, you've already given out in your Twitter and in this conversation as well, the likely action if nothing else is done beyond this. We've established what could be done. What's your gut of what does this do at all, if at all, anything to the system at large now? Do you think that damage has been contained, or could there be issues purely from Yes Bank, not from the other issues, purely from Yes Bank?
No, I think that risk is still quite minimal, at least for the banking system. I think the good thing is most of the other larger banks are fairly well capitalized, and they also don't seem to have the kind of asset quality or governance issues with which Yes Bank have. So while there are all sorts of rumors floating around, I think most people, or at least I would say some of the larger institutions, will probably not buy into those kind of rumors. People on the street might be a bit scared, but I think that's just rumor mongering, and it's not really helped if we keep saying that some other bank is also going to be stressed because of this. The issue is, I would worry about what happens to, say, many of the corporates to whom Yes Bank lends to, has given working capital loans, or those whose money is stuck in Yes Bank, and for the next 1 month they are not going to be able to access that. So I would be more worried about the asset quality on the MSME or SME or some of the medium or small corporates which have relationship with Yes Bank, and if they will be able to absorb this kind of hit that has happened on the financial system.
Well, that's a pertinent point, and therefore, Amit, one hopes that what the SBI chairman also said, that while we've given an outer limit of 1 month, resolutions could probably come in faster. I think the system-wide would probably need that. Dhananjay, just one final point, and something that maybe I should have brought up earlier, but quick 30-second view. This whole 81 bonds, on which is a complete write-off. Now, there are two parallel views here. One is saying it's quasi-equity, or at least deemed like that, and therefore it's okay. But in the literal sense, or in the fundamental sense, bondholders should come above equity holders. This move, does it have an impact not just for funds which hold the Yes Bank paper currently, but a lot of other banks, etc., which were having these bonds or were planning to maybe raise future money through that? Is this instrument dead now? Dhananjay?
I would not say so. I think this is very, yeah. Can you hear me?
Yeah, loud and clear. Please continue.
Can you hear me? Hello? So the thing is, I would not really generalize this. Clearly, in this particular case, the write-off essentially means that in the third quarter, there will be a sort of adjustment for the NPAs that will need to be needs to be provided for, and hence the tier 1 bonds are sort of written off. But I don't think this will be this should be a generalized thing, because other banks who require the 81 bonds, they will be able to do so. They will be able to raise. So I think this is all dependent on the credit rating of the particular bank, So I would not really generalize this. In the near term, yes, there might be sort of a sentimental impact, and possibly people who might be wanting to raise money right now may face some problem. But I think this is very bank specific and rating specific.
Okay. Well, viewers, firstly, to both of you gentlemen, thank you so much. Viewers, you can actually log on to Twitter and try and read what Amit Mantri has said, and then that was yesterday and today. There are some answers to that as well, and some assumptions along which those assumptions could change, and Dhananjay's views, and of course how this might actually evolve for the system at large too. Very, very important. Both of you, Dhananjay as well as Amit Mantri, thank you so much for joining in and giving us your time today. And viewers, thanks for tuning into this broadcast.
According to a recent